Let's learn about equity bonds. In part 3 of our 3-part series, you will learn about equity bonds, intrinsic value, and we'll also do a recap of all of Warren Buffett's pearls of wisdom from this book. If you haven't done so, I suggest that you first watch parts 1 and 2 so that you're comfortable with reading the income statement, the balance sheet, and the statement of cash flows, just like Warren Buffett. Welcome to Girl Investors. I am the founder and creator of Girl Investors. We are on a mission to improve financial literacy and an investing mindset among women of all ages. So if this sounds good to you, then please keep watching. I look for businesses in which I think I can predict what they are going to look like in 10 to 15 years. Warren Buffett. The equity bond. Companies with a durable competitive advantage have such predictable earnings that their shares act almost like an equity bond with an increasing coupon payment. This means that a bond equals a company's shares. Pretty neat, right? A coupon payment equals the pre-tax earnings of the business. So regardless of whether Warren is purchasing an entire business or only some of its shares, he looks at the pre-tax earnings, or EBT, to see if it's a good deal relative to its business economics. A company good enough to think of as an equity bond has per share earnings that rise over time, which could be either through their increased business, expansion of operations, acquisitions, or even share buybacks. Let's do an equity bond example. In the late 1980s, Warren purchased Coca-Cola shares for $6.50, which was pre-tax 70 cents per share and after-tax 46 cents per share. Warren expects the pre-tax rate of return of 10.7% to increase over the next 20 years, an annual approximate rate of 10%. So, disclaimer, if you're a grim value investor, Warren is not saying that Coca-Cola is worth $60 and trading at $40 and is thus undervalued. So to Warren, this investment in Coca-Cola is a dream because over the years, his initial investment compounds. In 1987, Warren started buying shares of Coca-Cola for the average price of $6.50 against a pre-tax earnings of 70 cents and after-tax earnings of 46 cents per share. Then Warren decided that his equity bond paid an initial pre-tax interest rate of 10.7%, which is 70 cents divided by $6.50 a share, on his $6.50 investment. So if he projected out the earnings growth of 10% annually, then by the end of 1996, 10 years later, the pre-tax earnings per share was $1.65, and this equates to a pre-tax return of 25% in 10 years. But after 20 years, the pre-tax earnings per share of $4.28 meant a 66% pre-tax return if you divide $4.28 divided by 650. And the stock market sees this return over time and revalues the share price to reflect this. So to calculate the share price, we divide the pre-tax earnings per share divided by the corporate interest rate. Remember, the earnings per share is net income divided by total shares outstanding. In 2007, the pre-tax earnings per share was $3.96 for Coca-Cola, and the corporate interest rate was 6.5%. So this gives us a share price of $60. And during 2007, the market valued Coca-Cola between $45 and $64 per share. And because earnings are consistent, the stock market tracks an increase in the underlying value of the company. So as a consequence, however, these companies tend to be vulnerable to a leveraged buyout. A leveraged buyout is when a company carries little debt, has strong earnings history like Coca-Cola, but if its stock price falls low enough, another company can come in and buy it by financing the purchase price with the acquired company's earnings as collateral. So this means that if interest rates drop, the company's earnings are worth more because that can support more debt. And the inverse is true when interest rates rise. And if this is confusing for you, let's find an easier way for you to understand what a leveraged buyout is. I won't belabor too much, but if you've ever bought a house with a mortgage, you've essentially done a leveraged buyout. Suppose you buy a $1 million house with a $600,000 mortgage and you had $400,000 of equity. This means you bought a house with 40% equity and 60% debt. If you sell the home for $1.5 million 5 years later, assuming that you've paid down $200,000 of the mortgage and the house price has increased now 50%, then your cash-on-cash return is 275%. Your equity increased from $400,000 to $1.1 million. Hey, listen, if you're enjoying this video and learning something, please click the like button. This will really help us. We really cannot talk about Warren Buffett's style of investing without discussing intrinsic value. So what was a pre-tax 66% return on a $6.50 equity bond in 2007 worth in 1987, 20 years before? Remember, the time value of money? A dollar is worth more today than it is tomorrow. So to figure out this problem, Warren had to calculate Coca-Cola's intrinsic value. The intrinsic value of a stock is its real value. What you do is you calculate the discounted cash flows for 20 years, total the discounted cash flows to calculate the present value of the 20 years discounted cash flow, or DCF, calculate the intrinsic value per share, and then compare the intrinsic value per share with the current share price. I'm not really sure why, but the authors didn't discuss intrinsic value in this book. However, I will just show you how they calculated it. So remember, Warren is asking, what was a pre-tax 66% return on a $6.50 equity bond in 2007 worth back in 1987? So they multiplied the share price by a discount rate of 17% to come to a $1.10 per share price in 1987. And the discount rate is really a judgment call. So when they multiplied $1.10 by Coca-Cola's price to earnings of 14 in 1987, they arrived at an intrinsic value of $15.40. And Warren argues that if he purchases a $6.50 share in 1987 and holds it for 20 years, Its 1987 intrinsic value is $15.40. In case you're wondering, in 2007, Coca-Cola was trading at $64 per share, which is quite amazing. So when should we buy and sell stocks? So it goes without saying that the price you pay for a stock and the price you sell it directly affects your investments. And the best time to purchase a great company is during a bear market. That is when you are most likely to find bargains. And generally, the worst times are during bull markets, when the price to earnings multiples are inflated. So Warren holds stocks as long as possible. So remember, when you sell or receive dividends, those gains are subject to taxation, which decreases your chances of getting rich. And Warren doesn't like taxes. However, it might be okay to sell your shares if you need the capital for something else to purchase, such as to purchase an even better company at a great price. Another time to sell is if the company is about to lose its durable competitive advantage. And finally, bull markets are a good time to sell because the price to earnings multiples are inflated. So what do you do with the cash? Well, you could save it, or you could buy government bonds or treasury bills until the next bear market. In 2020, at the time of making this video, government bonds are not high yield, so you might be better off just holding on to it and saving it, your cash. Let's do a recap. So we learned a lot in this series, and it's probably a good idea to do a recap of Warren's pearls of wisdom from this book. Financial statement analysis is like detective work. It takes a critical eye to notice financial shenanigans. The companies that have a durable competitive advantage have consistently higher gross margins. These companies own a piece of the consumer's minds, and therefore they do not have to change its products or service offerings. Companies that do not have a durable competitive advantage have wide variations in their SG&A. Under 30% is considered good. Companies that must spend large amounts of money on indirect operating costs have an inherent flaw in their competitive advantage and long-term business economics. Depreciation should always be used in the calculation of earnings. The EBITDA is a short-term delusion. Do not include infrequent or unusual events from the net earnings for a truer picture of what is happening to the company. The 10-year earnings per share trend should be on an upward trend and consistent. Look for companies where the inventory and cash are increasing together. Property, plant, and equipment are capital expenditures that decrease cash. And review the total assets to assess how hard it would be for a competitor to enter the business. And a business with excess cash with little debt can likely withstand short-term troubles if it is generating cash through its ongoing business operations. Companies with a durable competitive advantage require little to no long-term debt. Look for a current ratio greater than 1, but because of their great earning power, these companies can pay out dividends or buy back their stock, which could potentially lower their cash reserves and decrease the current ratio. Companies with a durable competitive advantage have enough earnings to pay off all the long-term debt in 3 to 4 years. A company with an adjusted debt-to-equity ratio of 80 cents or less is likely having a durable competitive advantage. Companies with a durable competitive advantage do not tend to have preferred stock, but they do tend to have treasury stock. Great companies use retained earnings to acquire other businesses to further increase their retained earnings. Companies with a durable competitive advantage have excellent return on equity ratios, which is reflected through an increase in the company's stock price. A company using 25% or less for capital expenditures based on net income, then the company likely has a durable competitive advantage. And regardless of whether Warren is purchasing an entire business or only some of his shares, he looks at the pre-tax earnings to see if it's a good deal relative to its business economics. So purchase stocks during bear market bargains and sell the company when it's about to lose its durable competitive advantage. Sell stocks during bull markets when the price to earnings multiples are inflated. And price to earnings multiples greater than 40 might just be the time to sell a stock. Congratulations, you made it to the end of this video and this 3-part series. You deserve applause. So tell us what you liked about this video or this series in the comment box below. Share it with us. Like any critical thinker, you won't stop here. You will keep reading and learning from different sources. And if you learned something, please like, share, and subscribe. Follow us on Twitter and visit our website. Let's build a guerrilla investing community and become great investors. Thank you so much for watching, and we'll see you very soon in our next video.